Stop what you're doing. Seriously. If you own Calix, or frankly, if you're investing anywhere in the AI infrastructure space right now, you absolutely need to hear this valuation breakdown. Welcome to The Explainer. Last week, I ran Calix through 5 core financial models and 2 legendary investor checklists, and honestly, what I found completely shocked me. We are looking at a company undergoing a massive technological shift and generating incredible cash flow, and yet the market is treating it like a total disaster. So let's start with a mystery. How does a company absolutely crush expectations, hit record revenues, and beat statutory profit forecasts by a whopping 33%, only to watch its stock immediately plunge 13%? It makes no sense, right? Now, I know the fear of buying the dip only to watch it keep dipping is a very real pain point for retail investors. It's exhausting, but looking at the hard numbers, this stock's intrinsic value could actually be over 60% higher than its current trading price. It is literally like finding a Ferrari on the clearance rack just because someone didn't like the color of the floor mats. By the end of this explainer, I promise you'll have a clear, actionable framework to decide if Calix is a Peter Lynch-style hidden gem or if it's just a classic, dangerous value trap. To figure out exactly why the market reacted this way, here is our roadmap for today. We'll cover the earnings paradox, dive inside Q1's record revenues, break down the Calix 1 AI transition, analyze that massive $525 million buyback signal, run through a SWOT analysis, and finally, settle the bull versus bear valuation tug-of-war. Starting with Section 1, the earnings paradox, beating the street but dropping in price. Let's unpack this weird disconnect that has everyone scratching their heads. When we look at the Q1 income statement, the hard numbers show Calix hit their expected revenue mark of $280 million perfectly. But what's really wild is the bottom line. They delivered a statutory profit of 16 cents per share. That didn't just meet analyst forecasts, it crushed them by an impressive 33%. Plus, they generated $7 million in free cash flow and kept their balance sheet totally spotless. And yet, post-earnings, the stock fell to around $39. To understand this crazy gap, we really have to look at where that revenue is actually coming from. That brings us to Section 2, inside Q1's record revenues and their 7 quarters of uninterrupted growth. The data paints a brilliant picture here. Calix is riding a massive 7-quarter growth streak. That record $280 million in Q1 revenue, that represents a 27% increase year over year, alongside a 3% sequential bump from the previous quarter. They are growing, and they are growing consistently. Breaking that down even further, the growth is super broad-based. It's driven heavily by their appliance sales, which pulled in $232.8 million. But, and this is key, it's also heavily supported by $47.1 million in higher-margin software and service revenue. Speaking of margins, their non-GAAP gross margin is sitting at a very healthy 57.2%. Furthermore, their current remaining performance obligations, or RPOs, which is basically just contracted future money in the bank, hit a record $157 million. That's up 22% year over year. So their pipeline is absolutely stuffed. Moving to Section 3, the Calix 1 AI transition, activating agentic AI for service providers. This is the technological shift driving all those revenue numbers. They've officially completed their 3rd-generation migration to a platform called Calix 1. This is an AI-native platform that represents 15 years of learning and over $2 billion of investment. $2 billion! It's designed to let broadband service providers activate what's called agentic AI to acquire subscribers, reduce churn, and just totally transform their internal operations. In plain English, they're selling the AI infrastructure that allows local and regional internet providers to actually compete with the massive telecom giants. It's a total game changer. Now, here is the absolute most crucial point. As of the end of March 2026, 100% of their customers have successfully migrated to this new platform. It's now active for more than 1,200 customers. So why does this matter so much for the stock? Because to pull this massive migration off, Calix had to run incredibly expensive dual cloud environments. Those heavy costs, which drag down gross margins sequentially in Q1 by 80 basis points, are officially resolved. They're in the rearview mirror. The heavy lifting is done. Which leads perfectly into Section 4, the $525 million buyback signal, reinvesting in the vision. Let's see how management is spending their cash now that the migration is over. Well, since July 2022, Calix has aggressively retired over 8.4 million shares by spending $361 million on buybacks. In Q1 alone, they dropped $171 million. And here's the kicker, you guys. The board just authorized an increase in the total share purchase program to a massive $525 million. This kind of aggressive capital allocation is a massive, blinking neon signal. Management is telling the market loudly and clearly that they believe their stock is deeply, deeply undervalued. By retiring shares right now, they are mathematically magnifying the impact of future earnings per share. They're betting big on themselves because they expect significant future growth tied to cloud expansion, AI adoption, and huge upcoming government broadband funding like the BEAD program. But we have to be objective. Section 5 SWOT analysis breakdown, the bear case revealed. If everything is so amazing, why did the stock tank? This pitch-grade SWOT analysis really highlights the exact tension worrying Wall Street. On the one hand, the strengths are incredible. Amazing 56.8% gross margins, integration into a multi-trillion-dollar tech addressable market, and cutting-edge AI. But we have to talk about the elephant in the room, the weaknesses. Despite those high gross margins, CALX is operating on a razor-thin 1.8% net profit margin. Their operating expenses are super high right now. Add to that some customer concentration risks and the terrifying fact that they are competing against absolute giants with endless pockets, like Cisco and Ciena. Wall Street bears see that tiny 1.8% net margin and they panic, worrying that a single macroeconomic hiccup or a pricing war will just wipe out their profitability entirely.
And that brings us to our final section, Section 6, Valuation, Bull versus Bear. Let's analyze this ultimate tug of war.
But let's look at the actual valuation models because the math is wild. Right after the earnings report, the stock was trading around $39.75. Yet when you run the cash flows and future earnings projections, impartial models paint a radically different picture. PitchGrade suggests a fair value of $55.80, which is over 40% upside. And Simply Wall Street's models? They're even more aggressive, projecting a fair value all the way up to $71.67. That's a 65% upside. Even the most pessimistic Wall Street analyst covering the stock has a price target of $52, which is still way above the current trading price. So what we really have here is a classic clash of timelines. The bulls are looking ahead. They see the AI platform scaling, those dual cloud costs totally vanishing, and management forecasting tens of millions in government BEAD program revenue hitting in late 2026. The bears, however, have tunnel vision on the immediate risk. They're obsessing over those thin 1.8% net margins, the complexities of expanding internationally, and the fact that, despite the huge earnings beat, the consensus price target was recently lowered to $66. Ultimately, you have to weigh the evidence for yourself. On one side, we have a company with 7 quarters of uninterrupted growth, a shiny new AI platform, and a management team aggressively buying back $500 million of their own stock. On the flip side, you have razor-thin net margins and intense competition that clearly spooked the market into a 13% sell-off. So I leave you to ponder this. With the math pointing to a massive upside, but the market screaming caution, is CALX a dangerous value trap, or is it a deeply misunderstood AI infrastructure opportunity? Think about it. Thanks for joining me on this explainer, and keep learning.